On April 13, 2026, Bitcoin stunned the world with a sudden and dramatic 5% rally, catching even seasoned investors off guard. The cryptocurrency, long known for its unpredictable swings, delivered a performance that few had anticipated, reigniting conversations across the financial landscape. In a matter of hours, Bitcoin smashed through the $75,000 barrier, a level that had been fiercely contested for weeks. The surge was not just a technical milestone, but a psychological one, as traders and analysts watched in disbelief while the price soared past this historic threshold. The move was swift and unexpected, igniting excitement and even a sense of euphoria across global markets. Social media buzzed with speculation, and financial news outlets scrambled to cover the story, as the rally signaled a powerful surge of bullish momentum that rippled through the entire crypto ecosystem. Trading volumes soared to levels not seen in months, as both retail and institutional investors scrambled to react. Exchanges reported record activity, with buy orders flooding in and liquidity providers working overtime to keep up with the demand. The sudden influx of capital highlighted just how quickly sentiment can shift in the world of digital assets. This breakout shattered weeks of sideways consolidation, overcoming a major psychological resistance that had kept the market in suspense. For many, it was a clear signal that the bulls were back in control, and that a new chapter in Bitcoin's price journey was beginning. For long-term holders, the rally was a moment of vindication, proof of Bitcoin's resilience and its remarkable ability to defy expectations time and again. Many who had weathered previous downturns now saw their patience rewarded, as portfolio values climbed and confidence in the asset's future was renewed. The event underscored Bitcoin's notorious volatility, reminding everyone that dramatic price swings are part of its DNA. But on this day, volatility was a force for explosive growth, propelling the market to new heights and drawing in a fresh wave of interest from both new and seasoned participants. As the price held firm above $75,000, the market's collective focus shifted. The question was no longer, can it hold, but rather, how high can it go? Speculation about new all-time highs and the potential for further rallies dominated discussions, fueling a sense of anticipation and optimism. The rally reset expectations and injected fresh optimism into a market hungry for its next catalyst. As analysts revised their forecasts and investors recalibrated their strategies, one thing was clear: Bitcoin had once again proven its ability to surprise, leaving the world watching and wondering what might come next. The rally's fuel? A classic short squeeze, one of the most dramatic and powerful forces in financial markets. When it strikes, it can send prices soaring in a matter of minutes, catching even seasoned traders off guard and rewriting the rules of the game in real time. Short sellers, who had been betting heavily on a price drop, suddenly found themselves in a precarious position as Bitcoin surged past $73,500. Their strategy was simple: borrow Bitcoin, sell it, and hope to buy it back at a lower price. But when the market moved against them, the losses mounted quickly, and the pressure began to build. As prices rose, margin calls started to hit. These are automated demands from brokers for traders to add more funds or close their positions. For many, the only option was to buy back Bitcoin at much higher prices, triggering a cascade of forced buying that sent the price even higher, feeding the frenzy. Each wave of liquidations pushed the price higher still, creating a self-reinforcing loop. As more shorts were forced to cover, the upward momentum intensified, drawing in new buyers and squeezing out the remaining bears. The squeeze turned what was once a strong resistance level into a launching pad. Panicked shorts scrambled to exit their losing trades, often at any price, adding fuel to the fire and accelerating the rally beyond anyone's expectations. This wasn't just organic buying. Fear and urgency from short sellers supercharged the rally. The emotional intensity was palpable as traders rushed to react to the rapidly changing landscape, and analysts scrambled to make sense of the chaos. The result? A violent, rapid price surge that cleared out leveraged shorts and propelled Bitcoin decisively past $75,000. The market was left in shock, with records shattered and traders reeling from the speed and scale of the move. It was a vivid demonstration of how leverage and market mechanics can amplify volatility in crypto. In these moments, the interplay between human psychology, automated trading systems, and raw market forces becomes crystal clear, making crypto markets both thrilling and perilous. The short squeeze left bearish traders reeling, licking their wounds and reassessing their strategies. Meanwhile, the stage was set for further gains, as the market digested the shock and looked ahead to what might come next. What made this surge remarkable was the tough economic backdrop. Oil prices soared above $100, and expectations for Federal Reserve rate cuts evaporated as inflation persisted. Typically, such conditions would dampen risk assets like Bitcoin, yet Bitcoin rallied hard, defying traditional market logic and puzzling analysts. The move suggested that crypto's internal dynamics, like the short squeeze and institutional buying, were overpowering negative macro trends. Bitcoin's rally in the face of adversity reinforced its reputation as a maturing, independent asset class. Before the breakout, Bitcoin was trapped in a tight range, support at $68,000, resistance at $75,000. Buyers defended the floor, while sellers and shorters capped every rally. This standoff created a coiled spring effect, with energy building for a decisive move. Geopolitical tensions, especially between the US and Iran, added to the uncertainty. Some saw Bitcoin as a safe haven, others as a risk asset, fueling choppy sideways trading. The longer the consolidation, the more explosive the eventual breakout. When the surge came, it liquidated shorts and confirmed the bull's dominance. The period of tense calm ended with a dramatic bang. A key catalyst was the extraordinary trading in Strategy's preferred stock, STRC. On April 13, over $1 billion in STRC shares traded hands, an unprecedented volume. Strategy's ATM stock offering raised nearly $800 million in a single day, all earmarked for Bitcoin purchases. The market knew what was coming, a massive buy order that would soak up supply. Traders and algorithms rushed to front-run the expected purchase, adding fuel to the rally. The anticipation of Strategy's move became a self-fulfilling prophecy, driving prices higher. The news sent a powerful bullish signal, convincing many that Bitcoin's path was upward. Strategy wasted no time, deploying its $796 million war chest to buy Bitcoin. The company's decision was swift and calculated, signaling to the market that it was ready to make a bold move. This wasn't just a routine investment, it was a statement of confidence in Bitcoin's future, and a clear signal that Strategy was willing to put significant capital on the line. At an average price of $73,400, the company could acquire over 10,800 BTC in one swoop. This massive purchase instantly made Strategy one of the largest institutional holders of Bitcoin. The scale of the buy was staggering, and it sent ripples through both traditional finance and the crypto world. For many, it was a sign that institutional adoption was accelerating faster than anyone had anticipated. This followed a $1 billion purchase just days earlier, showing relentless accumulation. Strategy's appetite for Bitcoin seemed insatiable, and each new buy reinforced its commitment to the asset. The back-to-back purchases were unprecedented, and they left analysts and investors alike scrambling to understand the company's endgame. Strategy's aggressive buying provided a psychological backstop for the market, reassuring investors. As prices wavered, the knowledge that a major player was buying in size gave confidence to both retail and institutional participants. It was as if Strategy had drawn a line in the sand, signaling that it believed in Bitcoin's long-term value. The anticipation of their purchase helped trigger the short squeeze, while the actual buying absorbed supply. Traders who had bet against Bitcoin suddenly found themselves scrambling to cover positions, fueling a rapid price surge. Strategy's presence in the market changed the dynamics overnight, making it clear that the rules of the game had shifted. The company's actions weren't just a side story, they were the main event underpinning the rally. News outlets around the world covered Strategy's moves, and the narrative quickly shifted from skepticism to excitement. Suddenly, everyone wanted to know what Strategy would do next. With each massive buy, Strategy reduced downside risk and validated the bullish thesis. Investors who had been on the fence now saw a clear signal. If a major corporation was willing to bet big, perhaps the upside was even greater than they thought. The market watched as a corporate whale reshaped the landscape in real time. Every move was scrutinized, every transaction analyzed, as traders and analysts tried to keep up with the pace of change. Strategy's moves became the central plot point of Bitcoin's explosive surge, forever altering the narrative around institutional involvement in crypto and setting a new standard for what's possible in the digital asset space. With its latest acquisitions, Strategy became the world's largest corporate Bitcoin holder. Its treasury swelled to nearly 781,000 BTC, a staggering share of the 21 million total supply. The company's $59 billion bet transformed it into a de facto Bitcoin investment vehicle. Investors seeking Bitcoin exposure could simply buy STRC stock. Strategy's ATM program has raised over $3.5 billion, all funneled into Bitcoin. This created a feedback loop. Rising Bitcoin prices boost STRC, enabling more fundraising and more buying. By locking away so much Bitcoin, Strategy reduced the available supply, amplifying price moves. The company became a giant sponge, soaking up supply and making Bitcoin scarcer for everyone else. To grasp Strategy's impact, compare its buying to Bitcoin's new supply. After the latest halving, daily new Bitcoin creation is lower than ever. Strategy's single-day purchase could absorb over 24 days' worth of new coins. This demand dwarfs miner supply, forcing buyers to compete for existing coins. The result: upward price pressure as the market searches for a new equilibrium. Institutional demand like Strategy's is a core driver of Bitcoin's bullish thesis. Each large purchase tightens supply, making Bitcoin scarcer and more valuable. The ongoing supply shock sets the stage for continued price appreciation. April 13, 2026 was more than a price spike, it was a turning point for Bitcoin. The surge past $75,000, powered by a short squeeze and institutional buying, showed Bitcoin's internal dynamics can overpower macro headwinds. Strategy's relentless accumulation is creating a lasting supply shock, raising the floor for future rallies. If other corporations follow, the supply squeeze could intensify. The brutal short squeeze was a warning. Betting against Bitcoin in a bull market is risky. Fewer leveraged shorts could mean smoother, less volatile upward trends. The day reinforced Bitcoin's core narratives: digital scarcity, institutional adoption, and its rise as a global asset. Bitcoin's story is no longer niche. It's a multi-trillion-dollar market, and the next chapter is just beginning.